Well, good morning, everyone. Hey, it's Shooter, Scott Henderson. We are going to go over primary waves, the August global trend ETFs. Of course, at the end of our presentation, please do review our disclosures. Okay, let me start off with my bias. I've had this periodic bullish phase, but the majority of this last quarter and even most of the prior quarter, I've been neutral, even though as we've run higher, and the reason is because the Mag 7s were leading us. So a majority of our members didn't have positions in the Mag 7 because obviously we can't buy at those type of levels, at least in a pragmatic way. So let me talk about my neutral stance. Now, it's my opinion that we are in an ABC corrective phase. So we have now completed C on the indices, and we are in the process of completing B, or they could still become impulse legs down, which would give us a substantially lower low. And that's where my hesitation is, caution is, because I don't want to find us on the other side. However, if history has taught us anything in this bull market, is it's buy the dip, buy the dip, buy the dip. However, this last sell-off, we saw the first occasion that I recall where on 3 different days we didn't buy the dip. Now, and that's pretty much how it occurs. Right now, the thought is jobs are not as bad as they thought they were, and inflation is waning, and also retail, meaning believe that real estate is going to turn around here because of rate cuts. So there's this bias in the market, aka, as Kurt calls it, the trader narrative. And we're flip-flopping right now like you wouldn't believe. It's, the jobs recession, I don't even think it lasted 6 hours as far as the tone this last week or the last few weeks. However, it's still a viable outcome because the market is still getting soft. And if the Fed doesn't jump and get on board here, that could manifest. So at this point, being neutral, meaning unless you have really less than a 50% allocation, I don't know that I would be adding here. And I would be very selective in what I add. And I would be very protective in what I add. For example, a lot of cash secured puts, because they're safe, just sell below our prior low on the weekly or at the low for the weekly. And you're pretty good for the next 60, 90 days, I would think. And if those shares get put to you, that, hey, that's the nature of the beast. Part of the game. Now, this next week, we're going to be really watching CPI. GDP is expected to grow at just about 0.6%. And trade balance they really think it's going to continue to increase. Manufacturing, as far as construction output, is expected to increase as well. And inflation is projected to rise to about 2.3%. So, again, we're seeing a reason why the Fed doesn't need to cut, and that is concerning for me. Now, the unemployment rate is something I'm going to spend a lot of time on the next few weeks. 4.5, we got a 4.3 print, sort of a scary print. Realize when we get our next print, we could see a much higher number than that. It tends to like the gap. So we could see 4.5 to 4.7. I don't think we get to 5% yet, but I think before the Fed react, I think we get over 5%. The reason being is the historic norm for unemployment as far as the Fed is concerned, and they disclosed this in the meeting, is 5.8%. And, reading between the lines, what is the Fed's motive here? The motive is not to make the stock market rally. The motive is not to get a Democrat into the White House, or at least we would hope not, or a Republican. They are there to manage their mandate, full unemployment and inflation at 2% or less. Right? So my thought is they hold until we get a normalized job rate. So that would mean they'll go to 5.3, 5.5, then they'll cut. Reason is because there's going to be time for that to bake into the market. So we may push to a 6% unemployment rate before the cuts take effect. So let's talk about where we are. I think real estate is a safe place to go because I think in this next meeting, I think either we get a 50 basis point cut because it's worse than we think it is, but I don't think that's the case, or they continue to do what they've done, or they're going to lay out the language to taper and or cut in some kind of model. Hey, by the first of the year, we expect to cut 0.25%, right? Now, note how well XLRE, the Real Estate Select Sector Spider ETF, performed last week. It went nowhere. Basically, we're at 41, 81, didn't budge, right? So there's some relative strength there. So I think on the next drawdown, it does the same thing. So if we head to south, I think this is a safe place to park some capital. So maybe sell some 40 cash secured puts, right? Now, looking at OMFL, Kirk, 2 months ago, I think put, hey, this is what I'm trimming. Good timing, by the way, Kirk. Now it looks like we've gotten our three, a little higher low, drive one, drive two, drive three on the trend line. Gives us reason to add something back. Nice pop off of that, nice sell volume, and then we came back. So the count doesn't suggest that we go much lower than that. Safe place again, maybe sell some 45 or 47.50 if there are 47.50 puts, just below our low. So maybe the 45s would be a prudent move, especially looking towards the upside. Then as that works, we wait for our next back test. Then I would add common shares or calls on that move. All right. Looking at Pacer Industrial Real Estate. You notice my theme yet, huh? It's the charts that look the best. What can I say? That was my buy. All right, breakout lines overhead. Again, note has had basically no downward pressure on this. The drawdown, relative strength again. All right, so again, maybe sell a 35 or 37.50 put if there are 37.50 puts. Again, I didn't look at the options on that. Then once actually here, you could buy some in the money calls right at $40 calls, stay shallow. You could do a monthly concept on this because I don't think it goes much lower than this. And those should pay because I think once we get towards this breakout line, the euphoria, the squeeze that's building here on this base would imply a pretty aggressive move to the upside with the count up towards about 52. So I wouldn't buy deep out of the money calls. I would stay shallow. Anything here shallow, half size, you're not putting a lot of risk on with whatever you're doing. Again, reduce position size, right? Tighten up your strike when we're in an unknown market. And since we have this neutral stance in the market, that's where we are. All right, so then let's look at Latin America. Now, the thing about the dollar, I'm going to talk about the dollar here and what happened in the yen, all right? For the longest time, it was probably 3 years, I used the USJPY as a marker for trading the S&P future. And it was extremely accurate. Well, I keep looking back, hoping it starts again because it was such a productive period. Now, the problem with the dollar is the Fed pretty much has to debase the dollar, which is going to hit every other currency on the map, including Mexico, including Latin America. And this chatter of a BRICS deal coming out of Mexico and Canada, I think would be catastrophic for these currencies because at that point, the Fed is going to pull back some of their support in whatever they're doing to help elevate those currencies. And we'll see that immediately in those stocks. So I find, even though the setup is here, we have a new primary wave setup at 2261 or 51. I see there's some downside. I mean, there is potential that we test the lows if the Fed continues to do what it's doing with the dollar and they continue to push the dollar and it pushes below 100. I think it's going to hurt Latin American entities. So I would do half of a half size on something like this in Latin America if I was going to add something here. Maybe sell some $22 or $23 cash secured puts would be about the most that I would do on that particular. All right. Now, Kirk also put out a sell on SPGP 2 months ago. Again, good timing, Kirk. We've now tagged drive one, drive two, drive three, right to trend support. That's just telling. Notice the euphoria that came in and bought it off of that. Notice off of this low, they bought it off of this low. Notice they bought it off of this low as well. We've got a decent push. I mean, this is our highest green candle that we've had through this entire leg. So I fully expect this to get right back to 108. You're not holding it for 40 bucks. It is not a long-term position trade. This is going to be a 2 to 3 month trade. You're going to hold on to it to that 105, 108. Now, this particular circumstance, 95 cash secured puts, maybe some $100 calls. I'd give it a little October if I was going to do those. And again, position size, position size, position size. Less risk rate until our bias changes and we have a full bullish bias. And truthfully, what I need is a divergent low. And even if the S&P fills the gap, right, it doesn't seed my bias. Realize the last 3 drawdowns did not get to target. They were shallow retraces, right? That doesn't usually happen 4 or 5 times. So this is the 3rd time. Number 4 is probably going to flush or 5 is going to flush. I can't tell you which one, but we're going to flush a little bit deeper at some point. Can't tell you when. The longer we hold out, the deeper it's going to be. So here again, we're managing position size, managing risk, understand what you own. All right, let's look at VPL, Vanguard. Now, notice this was an overshoot. drive 1, drive 2, and it overshot, and it's still saying we're going down to 66. So that would imply, and then just looking at all of these charts we've already looked at, I still believe this is a dead cat bounce. We're going to pull back a little bit, find a bottom about where we are, then do our bounce for our B. Okay, technically that is my favored play. Okay, we will know this week whether or not the buy the dip was not a dead cat bounce. I mean, basically we need to run this entire week. If we run this entire week, it's not a dead cat bounce. Okay, obviously the follow and continuation to build it back to the upside means we're starting that next leg for our wave 5 in a lot of names. So at this point, I would sell 65 cash secured puts once we get down to 66. Otherwise, I would hold my hand because again, that is tied to the dollar pretty aggressive. Now, A1A has been one of Kirk's favorites for a while. I like it back at 58. I don't really want to add something here, but you could sell some 55 cash secured puts once we get down there. But being how much it's drawn down, I wanted to make it, everybody aware of that because I know some of you are holding that position. So, maybe you structure yourself. Maybe when we start seeing some rejection up here about 66, maybe sell some covered calls on market weakness, shallow, just earn some income on it. Maybe 72, 75, something like that. That would be about the extent what I would do on A1A. Now, EPRT is another real estate trust. Notice how shallow the retrace was on the drawdown and how we closed at the high. That is telling. Also notice this buying volume that started coming in after this low. All right. So everybody right here sees the same thing I'm seeing. Rate cut. What does this do? Breaks out above this high. So about 32.80 is our breakout line. And I'm wondering why it's not on my chart because I remember correcting it, but it's not there. Anywho, trend support is down here around 23.50. Don't think we get down there. I think we hold up really well. We're broadening like we're going to start up. Once we get up to that 32, maybe we break down. So this really is not a place to enter, but it's a good way you can earn some bucks selling cash secured puts, maybe 27, 25, depending on what actually is available there for a strike. And that's what we have for this week, folks. Great trading. Until next time.